It was an ordinary March afternoon when James, a small business owner outside Manchester, found himself unable to withdraw £30,000 from his business account within a single business day. For most of us, £30,000 is a life-changing sum. For many companies, it's the difference between paying wages and defaulting on invoices. What made his story striking wasn't the headline itself, but what it hinted at beneath the surface, a deeper unease within Britain's banking system that hasn't been reflected in consumer sentiment or front-page headlines. To understand why an apparently routine withdrawal could falter requires looking past the public facade of bank profitability and into the structural stresses quietly accumulating in UK finance. Banks are intermediaries. They take deposits today with the promise of liquidity on demand and transform those funds into longer-term loans to households, businesses, and investors. Under normal conditions, this maturity transformation functions smoothly because not all depositors demand their money back at once, and because loans perform as expected. What becomes clear on closer inspection of the latest financial statements from major UK banks is that two pillars of this system, the quality of underlying loans and the liquidity buffer banks hold, are under pressure in ways that could challenge that balance. A first warning sign is the collapse of commercial real estate valuations, particularly those tied to offices. Before the pandemic, UK banks held significant exposures to commercial property, offices, retail space, and warehousing. According to the Bank of England's latest credit data, commercial real estate lending still accounts for a meaningful share of total business loans, even though values have been eroding. Remote work trends, which surveys from the Office for National Statistics, ONS, show remain elevated compared with pre-2019, have diminished demand for office space across major UK cities. As occupier demand falls, so too do rents and capital values. The Royal Institution of Chartered Surveyors, RICS, regularly reports rising numbers of valuers noting negative net effective rents in centrally located offices and significant discounting across regions. For banks, this matters because many of those loans originated when expectations about future rents and valuations were far more optimistic. These loans were underwritten with the assumption that an office building in, say, Birmingham or Leeds would retain a large fraction of its pre-pandemic value when it came time to refinance. But in 2025, the market tells a different story. Office capital values are down 20 to 40% in many city centers compared with their 2019 peaks. Borrowers reaching maturity on these loans often find that the asset securing their debt is worth materially less than the outstanding balance. Where refinancing was once possible, it may now be unaffordable or unavailable. In this scenario, defaults rise and banks must recognize losses. We saw early evidence of this dynamic in the recent increase in loan loss provisions disclosed by UK banks in their half-year accounts. Provisions, amounts set aside to cover expected losses, have climbed noticeably for commercial real estate exposures. This isn't speculative. It reflects banks' own internal stress tests and risk assessments. Higher provisions reduce capital and constrain banks' ability to lend elsewhere. In a system that depends on confidence, rising provisions signal that lenders are anticipating trouble, and that trouble is not being papered over. It would be easy to dismiss the commercial property issue as isolated, but it interacts with broader macroeconomic stresses. Since 2022, the Bank of England has raised bank rate aggressively in response to inflationary pressures, taking it from 0.1% in late 2021 to levels above 5% by 2024. Higher interest rates increase the cost of borrowing for businesses and households, which feeds through to loan performance. For commercial property investors, higher financing costs reduce yields and lower valuations further. For banks, it means assets that once looked secure are now riskier. Parallel to the commercial property story is the situation in the housing market for households. The UK mortgage market is one of the largest asset classes on bank balance sheets. As of late 2025, around two-thirds of outstanding mortgages sit on variable or shortly to reset fixed rates that were agreed in an era of historically low interest rates. The ONS and Bank of England data both show that the average outstanding mortgage interest rate has roughly doubled from the lows of 2021 to 22. What this means in practice is that monthly mortgage payments for millions of households have increased sharply within a relatively short period. Incomes in the UK have not kept pace with these rising costs. Median regular earnings growth, adjusted for inflation, has been sluggish since 2019, according to ONS labor market statistics. For households on the margins, those with limited savings or high debt burdens, this squeeze can translate into missed payments and an increased probability of default. Importantly, this dynamic is not evenly distributed. Data from the Resolution Foundation highlights that lower-income households devote a larger share of their income to housing costs, making them more vulnerable when rates rise. Compounding these pressures is a recent flattening and slight decline in house prices nationwide reported by the ONS. While aggregate figures can mask regional variation, several metropolitan areas have seen meaningful price softening. When house prices stagnate or fall, borrowers with large loans taken during the boom years can find themselves in negative equity, where the outstanding mortgage exceeds the value of the home. Negative equity doesn't automatically trigger default, but it does remove a psychological and financial cushion that might otherwise keep a household afloat during a rough patch. The interaction between asset quality deterioration in commercial real estate and mortgage stress among households is significant because it affects both sides of bank balance sheets, loan assets, and depositor confidence. But perhaps the most underappreciated stress signal lies in liquidity, the ability of banks to meet short-term cash demands. Liquidity coverage ratios, LCRs, are regulatory requirements designed to ensure banks hold sufficient high-quality liquid assets to survive a 30-day stressed outflow scenario. Public disclosures indicate that UK banks' LCRs remain above regulatory minima, but the quality and availability of those liquid assets matter. Government bonds, the highest quality asset in liquidity buffers, have been volatile, and the ability to sell assets quickly without loss depends on market depth. A bank can meet regulatory ratios on paper, yet struggle in practice if confidence falters. Confidence is crucial because modern banking is fundamentally built on trust. Depositors do not have long-term contracts. They can withdraw funds on demand. In stable times, this is unproblematic. But banking history, from the savings and loan crisis in the United States to Northern Rock in the UK in 2007-08, teaches that when depositors fear for their money, withdrawals can cascade rapidly, leading even fundamentally solvent institutions into acute distress. The episode with James's withdrawal difficulty, while not itself a crisis, is a reminder that operational and confidence frictions can emerge quietly before they appear in headline statistics. The concern, then, is not simply that individual loans may fail, but that these stresses interact with the banking system in ways that amplify risk over time. Banking crises rarely announce themselves with a single dramatic event. More often, they develop through a sequence of tightening responses that, while rational for each institution, collectively weaken the wider economy. After examining recent UK lending data, what becomes clear is that this process is already underway, albeit quietly. When banks perceive rising risk, their first instinct is not to fail, but to retrench. Lending standards tighten. Margins increase. Loan-to-value ratios fall. The Bank of England's Credit Conditions Survey has repeatedly shown, over the past year, that UK banks expect to reduce the availability of credit to both households and businesses. This is not speculation. It is a forward-looking assessment reported by the banks themselves. From an individual institution's perspective, this behavior is prudent. From a system-wide perspective, it creates a feedback loop that can turn manageable stress into broader economic weakness. Consider the effect on small and medium-sized enterprises. SMEs account for around 3/5 of private sector employment in the UK, according to government business statistics. They are also disproportionately reliant on bank credit rather than capital markets. When lending conditions tighten, these firms face higher borrowing costs or are denied credit altogether. Investment plans are postponed, hiring slows, and in some cases payrolls are cut. What begins as a defensive move by banks to protect capital feeds directly into the labor market. Rising unemployment, in turn, feeds back into household income insecurity and mortgage stress, increasing the probability of defaults on the very loans banks are trying to protect. This is how credit stress migrates across sectors. It is rarely confined to the origin of the problem. In the UK's current context, the initial shock maybe commercial real estate and higher interest rates, but the transmission mechanism runs through credit availability, employment, and household balance sheets. The Office for Budget Responsibility, OBR, has repeatedly warned in its fiscal risk reports that high private sector debt makes the UK economy more sensitive to interest rate changes than in previous decades. Household debt remains elevated by historical standards, even if lower than pre-2008 peaks, and much of it is secured against housing whose value is no longer rising rapidly. The time dimension matters here. Defaults do not spike overnight simply because interest rates rise. There is a lag as households exhaust savings, adjust spending, and attempt to refinance. Similarly, commercial property loans often have multi-year maturities, meaning losses are realized gradually as refinancing dates arrive. This staggered structure can create a false sense of stability. Bank balance sheets may look resilient today, but the pipeline of future refinancing risk is already set. According to industry estimates, a significant share of UK commercial real estate debt will mature between 2025 and 2028. If valuations remain depressed, losses will be recognized over several years rather than all at once. Against this backdrop, capital ratios are often cited as reassurance. UK banks report Common Equity Tier 1, CET1, ratios well above regulatory minimums. On paper, this suggests resilience. However, capital ratios are risk-weighted, meaning assets are adjusted based on models that estimate their likelihood of loss. The lesson from the global financial crisis is that these models can underestimate risk during periods of structural change. Commercial property loans backed by offices with uncertain long-term demand may carry low risk weights if historical data suggests stability, even as forward-looking fundamentals deteriorate. This does not imply dishonesty. It reflects the limits of model-based regulation in capturing regime shifts. Liquidity, too, deserves closer scrutiny. While headline liquidity ratios remain strong, they are designed for short-term stress scenarios, not prolonged confidence erosion. High-quality liquid assets are meant to be sold or pledged in stress conditions, but their effectiveness depends on market functioning. The UK gilt market, though deep, has shown vulnerability in recent years, most notably during the liability-driven investment crisis of 2022. That episode demonstrated how quickly even government bond markets can seize up under stress, requiring central bank intervention. Banks operating in such an environment may find that liquidity assumed to be readily available is harder to mobilize without central support. This brings us to the role of confidence and deposit behavior. Unlike in 2008, when retail banking was largely analog, today's depositors can move funds instantly via mobile apps. The speed at which deposits can leave an institution has increased dramatically. Internationally, recent bank failures have shown how quickly social media and digital banking can accelerate withdrawal dynamics. While the UK has stronger regulation and supervision than many jurisdictions, it is not immune to the behavior realities of modern finance. A sudden loss of confidence does not require insolvency. It requires uncertainty. Deposit protection is often cited as a backstop against panic, but its limitations are not widely understood. In the UK, the Financial Services Compensation Scheme protects deposits up to £85,000 per person per authorized institution. For many households and small businesses, balances exceed this threshold, often unknowingly because multiple brands operate under the same banking license. Even where protection applies, compensation is not instantaneous. The scheme aims to pay out within 7 working days, but this has never been tested during a system-wide crisis affecting multiple large banks simultaneously. For a household living paycheck to paycheck, or a business managing cash flow, a delay of even a week can be disruptive. There is also a distributional dimension to these risks. Higher-income households and large firms tend to have diversified financial arrangements, access to advice, and buffers that allow them to weather temporary disruptions. Lower-income households, renters aspiring to buy, and small business owners are far more exposed to tightening credit and payment disruptions. This asymmetry matters because it shapes the political and economic consequences of banking stress. Financial instability does not hit evenly. It compounds existing inequalities and can leave long-lasting scars on employment trajectories and business formation. None of this implies inevitability. The UK banking system is better capitalized than it was before 2008, and regulators are alert to emerging risks. The Bank of England stress tests explicitly model severe recessions and housing market downturns. However, stress tests are scenarios, not forecasts. They are tools for resilience, not guarantees. The question is not whether banks can survive any imaginable shock, but whether a confluence of plausible stresses, commercial property losses, household mortgage strain, and tightening credit, could interact in ways that strain confidence and amplify economic slowdown. What emerges from the data is a system under pressure, not collapse. The danger lies in the cumulative effect of defensive actions taken by banks, households, and firms simultaneously. Each actor responds rationally to perceived risk, yet the collective outcome can be contractionary. As lending slows, investment weakens. As investment weakens, productivity growth suffers. And as productivity stagnates, real wage growth remains constrained, feeding back into household financial stress. It is at this point, where financial strain begins to shape everyday economic outcomes, that the abstract mechanics of banking start to matter for ordinary life. The risks embedded in balance sheets do not stay there indefinitely. They surface through employment prospects, housing security, and access to credit. And it is precisely the slow transmission rather than a sudden collapse that defines how banking stress is most likely to be experienced in the UK over the coming years. As these pressures filter outward from bank balance sheets into the wider economy, the question shifts from whether a single institution might fail to how behavior changes across the system once risk becomes a dominant organizing principle. Financial systems are not only collections of contracts, they are networks of expectations. When expectations turn cautious, the effects are rarely dramatic at first. They appear instead as friction, delays, conditions, smaller limits, requests for additional security. Over time, those frictions accumulate into constraint. One of the clearest expressions of this constraint is the gradual freezing of credit. A credit freeze does not mean lending stops entirely. It means that credit becomes more expensive, more selective, and less forgiving. Data from the Bank of England already shows widening spreads between the policy rate and effective lending rates for both households and businesses. This widening is not solely driven by base rate changes. It reflects banks' pricing in higher perceived